What's up? I'm Dan Fredenberg, and this is another chance encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. I'm joined today with Jesse Dickens. How are you doing today, Jesse?
Fantastic, Dan. Yourself?
I'm fantastic as well because, after all, I don't know if you know this or not, Jesse, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? Well, this is a chance encounter where I interview commercial real estate syndicators, sponsors, investors, buyers, sellers, all that kind of stuff. And you might sit there and go, why would anybody do that? And the answer is, if you've ever heard of an off-market deal or a private deal, sometimes called a 506B syndication, well, the SEC insists that you have documentation of your prior substantive relationship, or else they will get ants in their pants, and nobody wants that. So I always make sure that I do this interview with anybody before we start talking about specific deals. But before we get too excited about that, I'm sure you'll have a great time and learn how to effectively communicate on the subject of commercial real estate. But Jesse, do you want to say a thing or two about being an, I don't know, an echocardiographer or something, or anything about yourself?
Sure. Real quick background. I have a degree in echocardiography, like you said. I scan ultrasounds of the heart. That's my W-2. I love what I do, but I got bit by the real estate bug back in like 2019. Really started in 2017 when it piqued my interest. Sat around on the sidelines for a while, waited for a market correction that never came,
Mhm.
and finally got in enough pain in 2019 to where I actually said, you know what? It's time to take some action, and I've been investing in multifamily and short-term rentals ever since.
I love it. I love it. So let's get started. The first section is on the distinct motivations. But before I do that, I got to say, but wait, check your eight. Jesse, I don't know if you can see through the camera and down in the user's device, but there might be this hideous subscribe button, and it's downright embarrassing. They should probably, okay, it's a stupid joke. But anyway, I do it in every episode. Let's talk about the five distinct motivations. By this point, I've spoken to hundreds or thousands. I've lost count of how many syndicators and investors I've spoken to. And of course, everybody has their own unique why. But I found at the end of the day, they fit pretty neatly into these five categories. And the reason why I ask these questions is because these deals take months to close. They take years to go full cycle. So we all need to know what's going to keep you sticking around, what's going to keep you from throwing in the towel at an inopportune time. And I find that these five different motivations, they sum it up pretty well. The first one of the bunch is preservation of purchasing power. What's that? Well, some people, they don't even have a W-2. The way that they make ends meet is from the proceeds of ownership. And if somebody is already in that financial situation, why would they go through the hassle of making another acquisition, you might ask? Well, there's a few scenarios. One of them is if inflation is rearing its ugly head, that's going to be eating away from the purchasing power of the cash flow. But the other time where somebody like this is going to be eager to make a new acquisition is when there's distress or an asset crash. A lot of people are saying 2024 is the year for getting those distressed properties like we haven't seen in years. And if I turn that off for a second, go to my next slide here. The second reason for getting involved in this, which is more close to where I am personally, it's trading time for wealth. Jesse, I'm sure as an echocardiographer, you have this issue as well. Me personally, I came from tech, so I was a high wage earner, high salary earner, And when you see the tax burden that you have in that case, you start to think it's like, well, maybe a bigger salary isn't the solution that we really need. You need to be using equity multiples. And so, me personally, having the CRM background for mass marketing and online funnels and all the CRM stuff like that, I started working for a guy who was doing 10 single family transactions every month like clockwork for years before he hired me. And I was going like, well, how is he able to keep his tax burden so low despite making way more money than any of the rest of us at the company? So that's why I made the jump and pivoted into real estate. But that's too subtle for some people, especially youngsters. They frequently are more interested in taking control of their schedule, or maybe it is they want to hustle like crazy now, so they retire early. Maybe it just means they want to work fewer months per year or fewer weeks per month, something like that. But this is some people's motivations. Some people think that it's the hidden motivation for everybody, but I assure you it's not. For example, the next group, they're fueled by ambition. They want to buy their entire hometown. They are in for that generational wealth to make sure that their great grandchildren never have to hold a day job. And that's what's motivating them to keep on doing these acquisitions. And it makes them fantastic parts of your team because they're going to be hustling into their 90s. Just like the last group, but they're not so much focused on their own ambition. They've found some sector of society, or maybe it's animals, the environment, maybe they want to send people to space. Who knows? But with any big goal like that, there's a huge financial component to it. And that's why some people are making these commercial acquisitions. So, Jesse, of those five different motivations, what combination of those do you think describes you best?
It's number two right off the bat, trading time for wealth. As a full-time employee, like I said, I enjoy what I do, but understanding the fallacies of relying on one stream of income has it's just that's it's become very clear that that's not going to work. And I love the ability of being able to buy back my time, my family's time, to allow us to do the things we love. If I still want to go out and scan hearts once that financial freedom and time freedom has happened, I can do that, not because my mortgage payment or the food on the table depends on it, but because I actually have passion and purpose in what I'm doing. So that is without a doubt the one that makes sense for me. I also love number five, helping people who need it, and being able to be more charitable and just with my time in general, and be able to give back in different kind of sense and have the means to do so. But I would say without a doubt, number two.
I love that. I love that. So, but that brings me to the next part, which is about risk. It's nice to be all optimistic about all these different things, but at the end of the day, real estate is a business and all businesses have risks involved. And if you've ever filled out one of those questionnaires in a 506B syndication, the financial questionnaires with all those invasive questions, and just so you know, the securities attorney should have insisted that everybody who invests, every partner, limited or general, they should have to fill that out first. And let me just go ahead and go. Actually, I'll just pause this right. And of course, I'm sorry for repeating myself for pausing it there, but the if you are involved in these deals, there really has to be a securities attorney involved, or else you're not going to be compliant, and that is a huge red flag. There are all sorts of problems. Your legal recourse is basically going to go out the window. So that's really really bad. But there was one question on the standard securities attorney questionnaire that I saw that really jumped out and said to me that it doesn't give me viable information. It doesn't give me useful information. And so I made my own tolerance for risk assessment question, which is a fill in the blanks one. There are many popular investment asset classes, but I think blank is too risky. So, Jesse, it can be inside real estate, it can be outside real estate, it can be both if you want. What's too risky for you?
I'm going to go crypto. And I say this having some crypto in my personal portfolio, but having a very small amount that I'm okay with that high risk tolerance. I'm in my 30s. I'm okay with taking some kind of higher risk, higher reward types of opportunities, but I just don't understand it. I still don't. I've had so many smart people explain exactly what it is, and I walk away from that conversation and I have no idea. NFTs, just different types of cryptos. the blockchain, I just don't fully understand it, and because I can't wrap my head around it, I would never put more than just a sliver of my portfolio into that.
I love that because after all, all of crypto, it's a strict appreciation move, right? There's no cash flow for owning it. It's just buy low, sell high. And commercial real estate needs a whole lot more than that. But here's one of the examples that I really like to use. This next slide, it needs a little bit of a caveat before I get to it, which is in this industry, you've got several different roles. Some of them are more front facing, marketing, public relations, that sort of thing. And very frequently, those types of people aren't the, spreadsheet jockeys or the underwriters, if you will. They're not going to be really digging deep into the numbers too far. And you need to get the real answers from the underwriter. But even though that's the case, everybody's going to have some deal metrics that they really hone in on, and there's no guarantee which one is going to be. So my next slide has 14 different metrics, and all of them are important, especially for any underwriter who's worth their salt. And for anybody in the audience who is only listening and not watching, I'm going to read them out. And Jesse, hopefully you can give like your top three or something like that. They are cash on cash, IRR, cost per door, that's especially in multifamily, net operating income or NOI, the going in cap rate. And one part that's implied about that is each locality will have its own standard cap rate for that period, and hopefully your going in cap rate is below that. Next one is the loan interest rate. Next is occupancy, and then average income for the region where the locality where the property is located. The amortization period of the loan is often a big appealing part for people. Next one is market versus in-place rent comparison. So what kind of difference is there? Then there's population growth. The sponsor, that population growth is also where the property is located. Then the sponsor record includes how many deals have gone full cycle, how many are on the go right now. Then waterfall slash split slash exit. I don't know why I'm tongue tied today, but that's basically what's going to happen at the end. Do you retain ownership after you've had your capital returned? And then the last one is DSCR, which is debt service coverage ratio. In other words, how much of the net operating income is going out the door just to the loan. So Jesse, of those 14, what are ones that you tend to hone in first before you do your deep underwriting?
Sure. So I'm going to look at I'm going to give you three, and I'll leave my most important one for last. So I'm going to go the waterfall, split, and exit. Just understanding the overall structure of the deal from a promote perspective. I want to know especially limited investors, should know what those splits are, and they should be comfortable with it. And my thought is, I invest passively. I want my sponsor to be compensated. I want them to be tied to the performance of the deal and create that alignment of interest. Second, I'm going to go IRR over cash on cash, because especially as a working professional, I'm not relying on this for the cash flow necessarily. I want to know what the overall yield is, but more importantly, with the time value of money. So is this a 3-year deal or is this a 10-year deal? Because a 50% return on my money in 3 years or 10 years looks very different from the IRR perspective. And most importantly, I'm going to go sponsor record, because look, you can have the best looking deal, and I promise every pitch deck you're going to look at is going to look really, really good, and it should. But I want to know who the sponsor is. I want to know about the record, and even a little bit deeper than that, I just want to know who they are on more of a personal level. I like to get to know them on a Zoom call and push the deal aside. Tell me about your family. Tell me about I want to know about, I don't need to know about your childhood or anything like that, but I want to know who the man or the woman is behind the business person and the investor, because life happens to all of us, and over the course of a 5-year deal, life is going to happen. So I want to know what your priorities are in life, and I want to make sure that aligns with mine. So those are my top three.
Fantastic answer. I love that. I love that. I'm eating it up like a subscribe, Sandwich. That looks delicious, doesn't it? That's really, really intense. But that's my cue to bring out the Dan Does Deals commercial core competency cube with the 6 different core roles in a commercial real estate deal. And if you're looking at this and saying, oh, wow, I really wish I could have one of those, you can get one for free at dandoesdeals.com. Like a complete dummy, I didn't even ask for your email address. That's the cardinal sin of marketing. You never, ever give away your freebie without asking for some sort of contact information. But I realize from the moment that I decided to pursue commercial real estate that everybody's career in this industry depends on the ability to communicate effectively on how these deals work. And this is the tool that I have for you to really help that out. And in every episode of Chance Encounters, I take a couple minutes to go through the different sides so that you also know how my guest fits into these deals. And we're going to start by talking about repositioners. They are acquisitions people. They're looking at all sorts of different properties. They're also doing all sorts of paperwork. They're doing that underwriting. That's the fancy word for doing the math, doing the arithmetic, because they have to figure out, first of all, is this seller slash broker even telling the truth about how much money the property is making? Because but the repositioner's real job at the end of the day is figure out how can they find more upside? How can they make this property make more money than it was previously? And there are a few different tricks up their sleeve. One of the more counterintuitive ones is when you meet repositioners, you'll go, why do they have this? Why are they spending all this time on financiers, lenders, people who deal with just paper and money, and the people who are running the deals, and they don't deal with anything else, right? So they're not GPs. So these financiers, the reason why the repositioner needs to know all sorts of them is because if the repositioner can secure a more advantageous loan, that goes straight to the profitability of the building. So that's why they're constantly, rubbing shoulders with financiers. But the next place, the more intuitive place that a repositioner is going to look is they're going to try and make the operations more efficient. They're going to stop those Benjamins from going down the toilet. But of course, there's more to operations than just unclogging toilets and collecting rent and mowing lawns or shoveling snow in my case. One of the things that I run into personally, because I focus on deals with 100 units or more, it's that generally you're going to outsource to a third-party property management. So what exactly is a GP to do to throw in their assistance? Well, me personally, between the web application assets that the building may need, that's one part. Also the automation to help the third-party managers take care of the property, that's another one. But the big one is comes with the understanding that in real estate, vacancy is the enemy. So if your third-party property manager still can't fill the units, you need somebody on the team with some serious marketing chops to get those units filled. And that's another thing that I contribute to my GP teams. But there's only going to be so much wiggle room in the operations for the repositioner. So the next common place to look is to get a contractor team involved to do a value add, to renovate the units, make the place nicer. The whole idea being that the next resident would be more than happy to pay more in rent than the previous one because it's nicer. But of course, it's not that simple. You can invest basically limitless amounts of money into the upgrades and you won't necessarily get a return on the investment. So you can't be gold plating the toilets. And at the same time, you have to make sure that the contractors are keeping to schedule. They're not using subpar materials or anything like that. And if you're like me, see, I don't know if you know this about me, but I'm from the internet. So that means I need locals. I need boots on the ground, somebody who can be there in an hour or two, because that can't be me. I'd still be stuck at an airport in an hour or two. So we need somebody who lives nearby, who can keep an eye on the contractors, keep an eye on the operations, just do surprise calls in. And then once that team is all put together, it'll be something like this. Let's say you're the repositioner in this hypothetical. You're a physician or an attorney or an engineer or an echocardiographer, who knows what you are, but you get this idea that, hey, maybe me and my pals can put 50K in each or 100K in each, and we can take over that 350 unit apartment complex that's just down the street. Well, in that hypothetical, the repositioner is going to turn around the financiers, say something like, hey, there's this awesome 350 unit apartment complex. It's tens of millions of dollars. Do you have, I don't know, tens of millions of dollars you want to lend us? Well, there's a problem with that. And this is the part that you should pay really close attention to if you're in a mentorship or a guru program, anything like that, because this is the piece that I find they really gloss over. The financier or the bank is going to turn around and say, who's your sponsor? Who's your KP? What's that all about? In order to be eligible for a commercial loan, somebody in the fold has to already own a similar asset. So the bank's not going to lend you the money unless somebody already owns a 350 unit apartment complex, so they know that you know how to run the thing. Now, on top of that, between the entire GP team, you need a balance sheet of at least the amount of the loan and you need a certain amount of liquidity. But if you have all those pieces, you got yourself a commercial real estate deal. So, Jesse, I imagine you're doing a bunch of financier relations. You're doing some repositioning, figuring out where you can add value, and then you're going to be doing some asset management. That's conjecture on my part. I don't really want to put words in your mouth. But of those six different roles, where do you see yourself contributing most of all?
Yeah, right now it's primarily underwriting and asset management. So I work with a couple different groups. In one group, I am the primary underwriter, analyzing all the deals. In both of my groups, I'm doing the asset management. So I enjoy both of them. It's you go through all this work. It took me a year before I closed my first deal of working on it week after week and getting pretty distraught about the whole thing. And then you finally close a deal and there's this joy, this excitement, this just it's incredible. But that's when the party actually starts, and that's when the real work takes place. So the asset management to actually watch a property come to life and see the execution of the business plan come to life and have to essentially manage a manager is it's I wouldn't say it's always the most enjoyable, but it's really fun to watch that once you actually get through the tranches with it.
I completely agree, and I can see in your eyes that that's something we definitely share. Like being able to make those decisions to make people's lives better as they are residents of a property. It really is rewarding, and it's a great way to use that side of your brain. So that's a fantastic answer. But let's move on to the buy box. And when real estate people are talking to each other, we say, "Hey, what's your buy box? What's your ideal property? What are you looking for?" We're asking about three main things. The first one's geography. Which state, which county, possibly even which neighborhood. If you're going to call it ideal, it's absolutely going to matter. The second one is size. And most of my guests on this show are in multifamily, which is apartment complex investing. And the way that you define the size of an apartment complex is by the number of apartment units. So the reason why we need to know what sort of size we're talking about is because the type of group that regularly takes over 10 unit apartment complexes will look fundamentally different from the ones who take over 150 or these bigger properties. So that size definitely matters. And of course there's other forms of commercial real estate that go off of square footage or acreage or whatever else, but that's basically the size is still going to matter. But the third thing is commonly called class. I don't like calling it class. I like calling it desirability because I realize that there's two very, very distinct parts of what they call class. And I separate those into condition and area. So if you're talking about condition, we're talking about how old is the building, how beat up is the building, what sort of luxuries and amenities are there. Really, we're talking about desirability, and that's the name of the game. So what about the actual facility? What kind of shape is it in? That's the condition. But when you're talking about the area, the things that you're asking about, especially in multifamily, is the school districts. What are the school districts like where the property is located? And then, of course, any kind of real estate, the crime rate is going to be very important. And then, of course, there's that old trope that every real estate broker says of location, location, location. I don't like that saying because I don't think it says much. And what I think they actually mean is traffic, traffic, traffic. If lots of traffic goes by any location every single day, then the place is going to be more desirable and therefore more valuable. And the way that they rank both the area and the condition, the class, is the same system as in grade school. So you have A plus at the top, and then you have A, and then you have A minus, then you have B plus, and so on. So Jesse, as far as your buy box, what's easier to say yes to?
25 to 75 units. We like that space of the mom and pop own a duplex is probably not going to be stepping up to a minimum of 25 units. We like being underneath the institutional grade assets, so being probably sub 10 million. And then we're looking at, I'll tell you again, a couple different groups. My primary group right now, I live in Denver. We're looking at Colorado Springs, so about an hour south of Denver, truly a secondary market. And we like secondary markets for a handful of reasons, but I won't get into that. So looking for B and C class value add, pretty typical story. We're looking at a property right now, actually throwing out an offer here shortly after this call, where we are. I'd say it's a B minus asset, just because it doesn't have. It's an '80s build, but it doesn't have any type of amenities. But really well kept in an A class area where the average median income is over $100,000 for that market, which is absolutely incredible. Great. It's like the best school districts. And so that's what we're okay with C class, but we would love for that to be in a B class area. We always want the property through the value add process to be able to come up to the level of the area. And that's where we think that there's a really nice arbitrage that you can create.
Excellent, excellent. So Colorado, Denver, that's the primary focus, and then when it comes to out of state, it's not ideal, is what you'd say, or are there another region or two you want to mention?
Yeah, we're in Tucson, Arizona, is where we have some properties as well. We have boots on the ground, as you had mentioned before, that live in Arizona, so we've got that covered. But again, so Tucson is a secondary market, just like Colorado Springs is. So we actually like Colorado Springs more so than Denver because of that secondary aspect.
I love it. I love it. So let's talk about people. And because there are six different main roles that I already mentioned in a commercial real estate deal, everybody is going to focus on one or two of those sides, and nobody is going to be all six sides for any meaningful amount of time. And that means that this whole community, it's so friendly because we're so eager to pair people up and build new teams so that they can get more deals, so that people in our network end up having more success, and it's contagious. But at the same time, we all have our own unique skill sets. You know, me with CRMs and marketing, content creation, all that other ridiculous stuff that I'm up to. I find that the people who I can help disproportionately, it has to be the sponsors and KPs, because they're the ones who already have real estate businesses established. If you are just starting up as a local or even as a repositioner, you need grunts. You need people who can put in 80 to 120 hours a week. And that is not how I'm at my most effective. That's just simply not in the cards personally. So those sponsors are wonderful to meet. I'm always eager to meet more repositioners, operations. You know, I interview everybody on here. But Jesse, if you have any 506B deals, please don't mention them specifically, because, you know, you don't want to be enticing investors on a B deal. But as far as the different roles on the die, who's in the camera who you can help disproportionately most?
Yeah, so I will say right off the bat, I'm not looking for any additional because my plate is just so full at the moment. But I'm happy to help out in any way that I can. If someone wants to look at some underwriting, if someone is interested in investing in Colorado, but is out of state, happy to be boots on the ground, or happy just to connect and help out wherever I can.
I love it. I love it. So let's talk about how to connect. Me, I have this distinct last name, makes it super easy to find me on LinkedIn. LinkedIn is where I spend most of my online time. But if you scan this QR code right here with your phone, that brings you to the FAQs page of 506 BME, which is the platform where I help investors, syndicators, and whatnot with the IT, which is used for documenting your substantive relations and making sure that if your laptop falls into the bathtub, then the documentation that the SEC will require in any sort of audit is not destroyed. So that's what that's all about. And then, of course, I have some books like Real Estate is a Scam on Amazon. That's about some of the nasty things that coaches end up teaching people that's on the wrong side of the law. But Jesse, we ended up meeting through LinkedIn. And is LinkedIn a great way to reach you, or is there a website, phone, email? What's the best way to reach out?
All the above. LinkedIn is the the only platform that I really spend any amount of time on, and that's have met some incredible people on that platform. So please reach out there. I'll leave my phone number, my email here, 720-229-9899. Text is the easiest way to get a hold of me. And Jesse, Jesse, at wealthcarecap.com.
I love
So
it.
feel free to reach out.
All right, great, great. Yeah, it's really exciting. And the last thing that I have to mention is actually not for you, Jesse. It's for you in the audience. It's my public service announcement. And now I'm no medical professional, but if you've been watching this episode and experiencing searing pains in your eyeballs and like migraine-like symptoms, it's got to be because of the hideous subscribe button that's down there, and you can get rid of it for free. Basically, the trade-off, of full disclosure, I want a ton of people to click on it because then YouTube will actually start paying for these videos instead of me. I think that would be amazing. And the trade-off for you, just so we're clear, as I said, it's totally free. All it means is my videos may show up on your list of suggestions on YouTube, but you can go ahead and ignore those suggestions because quite frankly, I just appreciate the fact that you spent this time with me. Just like Jesse, I appreciate you joining me. This has been great.
Yeah, thank you. Appreciate it, Dan.
Awesome. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.